Hi everyone. Today we are going to learn about the concept of indirect taxes. We are going to learn about meaning, definition of indirect taxes. We are going to learn about how to apply our knowledge about indirect taxes to a diagram. We also want to understand that when indirect taxes are being used by the government as a way of intervention, how would that impact the market? How is that going to impact producers and consumers? Like every intervention, indirect taxes are also going to have some good points and some drawbacks. So I have just created this layout for you to understand that when indirect taxes are being imposed by the government, how is that going to change the market in terms of the quantity that is being traded, in terms of the price that the producer is going to receive, and the price that the consumer ends up paying for. So let's get started. So a simple definition, let's start with that one. When we are talking about indirect taxes, we are talking about the tax that is being imposed by the government primarily on the producer, and the producer, in order to protect their profit margins, will pass them on to the consumers. So the final price that is going to change for the consumer will be different from what they were paying earlier without any intervention. So let's try to apply this basic definition to this graph and get started. So you can see at the graph I've already drawn a demand curve, we have supply curve, and we have a market interaction at price P and quantity Q. At this stage, there is no government intervention. So let's assume a scenario that the government has a certain objective. It could be to reduce the consumption of cigarettes, and they increase or impose indirect taxes on cigarettes. So how can we show that? Remember, indirect taxes are primarily on the producer. Therefore, the supply curve is going to shift inwards. Whenever supply shifts inwards, the supply cost for the producer is going to increase. So, as I said before, in order to protect or adjust their profit margin, increase in supply cost will also lead to increase in the price that the consumer now has to pay. So prices have gone up from P to P1. That is also going to impact the quantity that will be traded, that will be demanded in the market. Increase in price is not a good news for the consumer. So here we are assuming that it is really going to lead to contraction of demand from Q to Q1. The most important thing that you would like to remember here is that yes, it is going to lead to increase in the market price, but how much impact it is overall going to make in terms of consumer burden would depend on the concept of price elasticity of demand. We'll come back to that later as we complete this diagram. So we can see that this is going to be the area of consumer burden. Consumer pays price P1. Now, when we want to understand that, okay, how would the producer be impacted now that their supply cost has gone up? Definitely, they are not receiving P1 as the price. From P1, which is a market price, they have to pay taxes as well. Therefore, the price that the producer is going to receive is going to be P2, which is way lower than what they were receiving at a free market level. So producers are also not going to be too happy about it. So P2 is going to show us the price that the producer is going to receive in the market after introduction of indirect taxes. So this is the overall view of how your diagram would look like. A great way for you to show to the examiner, to your teacher, that if I'm saying that producers are not going to be happy about the indirect taxes, consumers are not going to be happy about indirect taxes, there's a reason to it, because they are having that burden of increased prices and reduce profitability for the producer. So if producer is a loser in this case, if consumer is a loser in this case, who actually would be the winner when I want to think about the concept of indirect taxes. Let's label this. So let's label this A and K. All right, we want to consider this area now. Now, government, what is government going to get from this intervention? Government is going to receive revenues from the collection of taxes. So, for the government, the impact is that it is a source of government revenue, and it is also a way for them to correct any sort of market failure. Therefore, if we want to highlight this area right from P1 to P2, this area is the area of government revenue. So we can write down here, if I'm considering P1, P2, this will be government revenue. All right. Now, government care, and this is one benefit, when we are thinking about indirect taxes, that what is government going to do with that? Government is going to help the funding of public services by using indirect taxes collection. They are also going to use it a way in which they can discourage the consumption of demerit goods like alcohol, cigarettes, or any good and service that contribute towards negative externalities. If I want to think about the impact, how would we talk about the impact on consumer? You will relate that to the diagram and say that anytime supply cost increases, the consumer ends up paying high prices, which in turn would lead to contraction of demand. What's happening for the producer? Let's see. We can see that for the producer also, the supply cost has increased as this curve has shifted to the left. Therefore, they have to now readjust their profit margins. They have to see what could be done in order to maintain that level of profitability, or in order to try and survive in the industry. Overall, if I want to think about indirect taxes, imposition of indirect taxes from the viewpoint of consumers and producers, you can see it is going to have a regressive impact on people with low income. It is going to reduce their purchasing power because now they end up paying price P1. Why is it not good for the consumer? Sorry, why is it not good for the producer? That is because increase in supply cost reduces the profit margin, and in the long run, it can actually reduce international competitiveness of domestic businesses as well. So this is a thing with every intervention you would learn during your A levels, that they are never going to be perfect. Every intervention will be having some losers and some winners in the case that government is going to use them. It really depends that what is the prime objective of the government. Why would they want to use that? So this is all about you trying to understand indirect taxes. Remember, your classic way to evaluate indirect taxes is it depends. It depends on the price elasticity of demand. If I am talking about a good which is inelastic, it could be any good which is addictive in nature. For example, if we want to think about cigarettes, in that case, the producer can easily pass on the burden on the consumer. But if we are thinking about a good that is elastic in nature, then the consumer and producer, they share the burden. So elasticity would change how the market is going to look for the producer and for the consumer. So that was all about indirect taxes. I hope you liked the video. Have a nice day.